Good afternoon, everyone. My name is Lyle Wahlberg. I'm one of the partners at Telemus. We're really glad you're joining us for our webinar this afternoon. Just a quick housekeeping item. If you have any questions during the presentation, utilize the question box in the control panel to ask your question, and then we'll answer all of them at the end of the presentation. Well, welcome again. We're glad you joined us. Our timing could not have been any better. When we scheduled this webinar, we really didn't know what the markets would be doing. And obviously, after the last week and a half, it has been a crazy market. We've seen volatility return to the markets, and we actually have witnessed the largest drop since we saw in 2008. Thanks to the coronavirus scare. So today, we're going to try to simplify something that's very confusing to a lot of people, and a technique that we have used at Telemus and continue to utilize at Telemus for hedging and exchanging risk. The topic was concentrated equities, but we can use these strategies, and we'll go into it, for any portfolio, including large diversified portfolios. But for the most part, there are three techniques that can be used and different ways to accomplish them. You can exchange risk of your portfolio for a different risk. We'll talk about that. We'll go into ways to generate additional income off of a portfolio, specifically a position that is a highly concentrated position. And the other is to really just buy some insurance and reduce risk overall. So those are three things we are going to try to accomplish today and talk about strategies that can get that done. When you're talking about concentrated positions, typically people not inherit, but they accumulate their assets over time. Most of these concentrated positions, if you've sold a business, if you were lucky enough to buy a stock and it's appreciated quite a bit, you have large built-up capital gains, and most people are hesitant to sell, but they understand that they probably do need to diversify in some form or another. So quickly, Telemus, what are we? We're a registered investment advisor, one of the largest in the country. And we provide unbiased advice to our clients. We are a fiduciary. We put our clients' interests ahead of our own. And we are a fee-only relationship RIA. One of the things that we do from time to time is we identify advisors that complement or do things that we think can benefit our clients. We were introduced to SpiderRock a number of years ago as another RIA that could help us with the problem we were having for some clients who had concentrated positions. SpiderRock is based out of Chicago, although some of the founders and who you'll talk to today are Michiganders. We have grown to appreciate their approach, how they handle this question of diversification, of concentration, and of reducing risk. One of our jobs is not only to accumulate wealth, but to help our clients stay wealthy. One of the ways you can stay wealthy is by not seeing declines in the market and seeing declines in the portfolio. So this is really a way to stay wealthy, reduce risk, and possibly generate more income. With that, I'm going to introduce our speaker today. Blake Dinger I'll let him give his background, but he has been with SpiderRock. He has been involved with our clients, and I'm going to turn it over to him to let him go through some of these high-level concepts. Again, use the question function, and we will answer any questions at the end of the presentation. Blake, take it away.
Thanks, Lyle. Appreciate it. Again, my name's Blake Dinger with SpiderRock out of Chicago, and happy to be given the opportunity to speak here today. So Lyle, I think, hit the main points of what we do and who we are. I will reiterate. Again, we are an asset manager based out of Chicago. All we do is trade options. So the firm itself was founded back in 2013. We've been raising assets since. We've got a little over $1 billion in assets under management. And again, all of that is various types of hedging, income production strategies. You name it, we likely do it if it involves derivatives. If I were to look at our strategy offering set, I'd kind of bucket it into three different things. That first bucket is, call it single name hedging. So your client has $5 million of Apple and a cost base of 0. And we'd like to either hedge or try to monetize that asset. But having it sit there isn't acceptable. So how can we create a payout profile that suits client goals? The second bucket, I would say, is same idea in terms of hedging, but on a portfolio level. So a situation we see quite often is my client has or started with a 60-40 portfolio. Given the bull market run over the last decade here, that 60-40 portfolio is now closer to an 80-20 portfolio. I need to rebalance. It's my fiduciary responsibility. How do I do that, though, without generating a massive tax bill today? That's a very applicable case that we see here recently. And finally is this idea of exchange fund replication is what we'll call it, but how do I exchange risk? So I've got a single name or a basket of securities, and again, kind of gets back to the alteration of a payout profile to try to suit your client goals and meet objectives. So those are the high level three buckets I think we'll hit on. Again, I'll echo Lyle and say, if you've got any questions, please do ask. This is your time, but with that, I'll get moving here. So if I'll skip ahead here. So again, just kind of, I think, Lyle, I assume the deck will be available after the fact, but give a sense here of just what things we do. Start with single name stock hedging. So the two by and large main variants of this that we see for, again, the situation of I've got $1 million worth of Apple. I'd either like to monetize or hedge that. Bring us back to I'd like to write calls or I'd like to collar a position. This chart right here shows blue line what a covered call, by and large, how that alters payout profiles. So we're going to go out into the market. We are going to sell a call. We're going to collect some premium for selling that call. And by and large, that is our hedge. So wake up in 6 months, 12 months, wherever Microsoft is, what we've done is effectively pulled forward future total return and cash flow to create income today. And that can potentially provide us with a hedge or distributable cash flow, to the client right this second. That's the blue line. The teal line here is, I would say, the scenario where you've got a client who has $1 million worth of Apple, and we're waiting for some sort of generational event in order to sell that Apple and step a cost base up. That's the usual route we see here. Or a client is just plain bearish on whatever the stock might be. In that instance, what we can do is go out into the market, sell a call, sell that potential, future upside, and purchase a put to give us an actual floor in the value of the stock from now until, whenever the option itself expires. So getting a little more granular, this is an example with Microsoft. If you, what I'll step back and say is that, regardless of strategy, if you guys have got specific examples that you'd like to pass along, what I'm showing on this slide is the proposal that we would, put together and show you in real time what these scenarios would look like. So for this specific example, Microsoft, client's got about $880,000 worth of equity. We go out, we sell calls. In this instance, we're selling June of 2020 calls. I'll kind of work my way across the top here. There's a risk reduction associated with that of about 37% in terms of mark-to-market the client feels. We're going to collect some premium again for selling that call option. That is our hedge. So in this instance, we estimate we'd collect about $30,000. There's obviously a tenor of the option. The annualized rate of return client would feel or potentially expect to receive in this instance is about $84,000 if we assume that in 4 months we wake up again and can sell the exact same option, including a dividend yield,
Blake,
subtract the fee. Yep.
Blake, let me interrupt for 1 second. Take a step back. You're using the word option, and we're talking about covered calls and puts and whatever. Just for our clients that have heard options are risky, right? I mean, you go and options are too risky for me. That's everyone, they churn the account. The options are too risky. Take one step back for everyone that's listening that maybe is not as familiar with options and explain why, in fact, they might be more conservative in some situations and strategies than they are risky.
Yeah, absolutely. So, everything we walk through here today, be it a covered call, be it a collar, it is risk reducing. Options have, I think, maybe a connotation, as you just alluded to, that, there is inherent risk to them. That's true. There will be no strategy that we offer or talk about here today that, is not designed and offered with the goal in mind, really, of risk reduction. What we are trying to do here, to echo what you said earlier, is stay rich, not get rich. So again, everything risk reducing, trying to, maintain capital base and that sort of thing. So like I kind of said here, two popular strategies that we offer here in the single name hedging basket, call it, are writing covered calls and collaring. Regardless of the strategy you choose, and again, maybe it makes sense to kind of dig into those, how you'd end up in either venue, at another time. Just know by and large they are hedging strategies. One of the the real popular things we've seen lately is using these types of strategies to not only hedge but help you guys solve for the end goal of liquidating a concentrated position through time. So, adding a strategy like this is not only risk reducing, but what it's going to do is give you guys another tool in your tax toolbox, so to speak, such that at the end of the year, at the end of an option expiration, there will be, gains or losses associated with this strategy that can help you guys liquidate, these concentrated positions through time. We refer to that framework as strategic liquidation. So diving into this for covered call specifically, if we sell calls and the stock is flat or the stock is down in a year's time, just to paint a simple picture, the two scenarios can really play out. What I'm showing you here is that stock is flat or down and our options have made money. We can use that premium to pay a tax bill or a tax liability resulting from the sale of some pro rata amount of your Microsoft stock in this instance. The other scenario that can occur is the options lose money, the stock's rallied. So clients made money. We have to go back and buy calls at losses. But what we now have, again, are losses that we can use to liquidate a concentrated position through time while delaying that tax liability. So full circle, anything we offer in single name or realistically portfolio hedging can be approached with this strategic liquidation sort of mindset where we're reducing risk day one, we're monetizing a portfolio or a single name position through time. And also now we've got this capital gain loss bucket with which we can liquidate or rebalance and defer tax liabilities through time. So exchange fund replication, I'll swap. So the first two things that I've talked about in terms of covered call and collar are risk reduction on a single name. About a year and a half, 2 years ago, we had clients come to us and say, hey, I am looking at an exchange fund. I really don't like the idea of I need to be a qualified purchaser. The fees are massive. There's a 7-year lockup, and there's no tax loss harvesting or there's no tax management in the interim. At the end of 7 years, I am, delivered back a basket of still low basis equities, and I'm, no better off from a tax standpoint than when I started.
Blake, let me just stop you real quick there.
We came up
Blake, let me just interrupt. Exchange fund, so everyone knows, we've used them in the past. Eaton Vance, Goldman Sachs are pretty much the only two out there that are still doing them. It's basically where you take a position if they accept the stock. There's a lot of situations where the exchange fund won't even accept a certain name into their portfolio. What they're trying to do is take in stock from all sorts of different investors and replicate the return of an index, whether it's the Russell 1000, the S&P 500, or whatever index it is that fund is set to replicate. What happens is you put in $1 million of Microsoft, you have to leave it there for 7 years, and at the end of 7 years, your return does not replicate Microsoft, it replicates that index. And at the end of the 7 years, if you want your money back, you usually get your shares of Microsoft back plus some other basket of stocks that they have left over from other investors. So exchange funds have been around a long time. Unfortunately, the problem with them is they sometimes restrict who can get into them by the name of the stock that you're looking to exchange, and also they are very expensive. So back to you, Blake, and sorry to interrupt you.
Yeah, no, thanks for the high level there. So exactly what Lyle just said. Client, comes to us and says, I am looking at this. Is there a way you guys can improve upon that? If so, what is it? And so what we said, or what we've come up with, is if I take a step back and think of a single name collar that is Microsoft on Microsoft and is synthetically de-risking my Microsoft position, well, to the tune that we can do that with a short call and long put, a collar on Microsoft, we can do the exact opposite with an index like the S&P 500. So in collaring your concentrated positions, so sell, call, purchase, put, what we can then do is do the exact opposite in an index. So sell, put, purchase, call. That structure itself tries to replicate the return stream you would expect, an index-like return stream, while maintaining your original existing position and just adding options into the account like you would see right now. So there's no limited partnership, there's no LP interest, it's daily liquid, there's no upfront fee, much like most of these exchange funds, and there's tax management in between. So that framework of strategic liquidation using single name and index gains and losses to help liquidate the concentrated position through time is, in our opinion, a better mousetrap for solving that, again, either reducing concentrated risk or swapping concentrated risk. That strategy, again, is called exchange fund replication. So I'll talk for a second on reducing concentration, but equity concentration, and more so just rebalancing portfolios that may be a bit over their skis in terms of equity risk. Again, I come back to the idea of the 60-40 portfolio that is now 80-20 and is prohibitively expensive from a tax standpoint to rebalance, but client's strategic asset allocation says we need to be back to 60-40. What's a better way to do that? So there's a number of different options here. I will focus on the collar offerings here. We can talk about call writing, but I'll start with collar. So there's two types of portfolio collars that we typically offer. One is a put spread collar, and the other one is a regular collar, just like you'd think about with a single name. So sell, call, buy, put. Put spread collar's been super popular, so I'll hone in on that, as this payout profile has been quite palatable to a number of clients. The idea here would be to look 5% down a year out in time in the S&P 500 and purchase a put. So that's like an insurance policy. Market goes below 5%. In a year's time, you've got a floor essentially in the value of the portfolio. What we turn around and do in order to help finance that put option is sell a put about 20% down. So what you have for a year's time is protection from down 5% to down 20%, after which you're participating 1-for-1. Now, that structure itself, that put spread, is still day one costs money. So what we then do is turn around and sell calls, such that the whole package day one is self-financing, and you now have a payout profile in a year's time that is protected from down 5 to down 20, after which you're participating 1-for-1. And you've got a participation rate, much like a structured note, on the upside. So that participation rate hovers between, I would say, 40 and 45% on the upside.
So Blake, I think the easiest thing for most people to grasp in this slide that you're looking at is the idea that we're talking about the S&P 500. In the bottom right corner is the index return. If your portfolio, if the S&P 500 went down 20%, then if you have this strategy in place, you would only go down 2.78%.
Correct.
Obviously, if the market goes
sleep at night protection.
Yeah, if the market goes up 20%, you're only up 10.18%. So you're giving away some of the upside, but there's substantial amount of downside protection, especially for the first 20% of the downside of the market from whenever this strategy is implemented.
Correct. So that kind of comes back to your original statement of this isn't get rich, this is stay rich. This is, by definition, a hedge. So again, with this structure, that trade-off of, market up 30% last year, am I comfortable with market up 20% this year, me being up 10 for that sleep at night protection, the down 20, the down 30% scenario. So the other structure here that we can offer on a portfolio level in terms of collar is just like a single name collar, Microsoft on Microsoft, a collar on your portfolio. So what's happening here, what's happening with both of these strategies is you guys have got a portfolio, you send it over to us, and we do the calculations on our side to say, this $1 million of a portfolio just sent us is so many dollars worth of S&P 500 exposure. And we're hedging that exposure using S&P 500 options in both of these instances. So here, this could be a 40-name portfolio that we are hedging using S&P 500 options a year out in time. Just like a covered call on each of your individual names, what we're doing here is saying this portfolio is so many dollars worth of S&P, selling S&P 500 calls to purchase S&P 500 puts. So in this instance, you've got the sort of 1-year payout scenario of participating 1-for-1 up to 10%. So market up 20%, you're going to only be up 10%. market down 20%, you're participating to almost that spot, but below 20%, so truly a 2008 style sell-off, you're going to be capped at 20% down in a year's time. So this is, that crisis protection of I want to hedge below a 20% drawdown for a year's time, but in the middle, I'm participating. The other, to come back to the income or the monetization of a portfolio, the other strategy we can offer here is only the sale of calls on your portfolio. So again, you deliver us $1 million of a portfolio. We are beta adjusting that back to the S&P 500 and selling S&P 500 calls against the portfolio, much like a single name covered call, and actively managing that call right such that your risk reduction is about 50% of whatever you bring us. So in this instance, 3 months out in time, you can see if we sell calls, again, that call premium we collect day one is your hedge. So if we sell off, you have the 2.4% in call premium you collected, and on the upside you are capped. So rinse, repeat this over and over and over. It is our hope that your call premium builds up over time, and that is your true hedge in a sell-off. And
so in this example, so Blake,
go ahead.
Blake, in this example, so everyone's with us, you're basically capping your upside, but you're returning yourself that yield or income. So this would be for someone who says, I've accumulated enough wealth, in appreciation, but I need to generate more income. And this would, in this example, would generate about 11% annual income to this portfolio.
Correct. The other real applicable scenario for this strategy in particular, I'd say are RMDs, so retirement clients, or simply just clients who are taking, some known cash flow out of the account. Volatility is your enemy, right? The idea that if we sell off and you have to liquidate some portion of equities at a lower point than here, that's bad when knowing that income or knowing that a cash flow is coming out of the portfolio. So the trade-off in upside that you see here in a strategy like this is also providing you cash flow to distribute for RMDs for that monthly income that a client's taking, regardless of what the market's doing.
Great. You want to give us one more idea, and then we'll open it up to questions?
Yeah. One thing I'll say, Lyle, is that, again, I come back to, if you guys have got examples of this, obviously the slides I'm showing you are from, call it a week or more than a week ago, a couple of weeks ago. The vol environment has changed rather dramatically. So, what's 11% annualized this 3 weeks ago is certainly more than that today. So regardless of the strategy, if you've got examples you'd like to look at, the vol environment has certainly changed and made all of this even more attractive. And so we're happy to put together proposals.
Right. Just so everyone knows that the more volatility that's in the market means that these strategies look that much more attractive. You get more income, you can cover more downside, and give away less upside. So the fact that we've had a week and a half of extreme volatility has made these strategies even more attractive from a protection or income standpoint.
So the last thing I have, and I'll hit on this briefly, and then let's open up to questions, is put writing on a portfolio. Lyle, if you want to hit on this, great. This would be a way to generate additional income on top of a basket of fixed income or cash. So two sort of routes we see clients run this is, one is an actively managed strategy that you can pair with cash, treasuries, a muni manager, where, clients are saying, I am looking to take an income off of this portfolio, but treasury yields, 10-year treasury yields now below 1%, that's not going to cut it. So what are other sources of potential return that we can add to a basket of fixed income? Index put income is our strategy name for this, where we go out and manage a basket of short puts on top of your existing, again, fixed income or cash portfolio, and attempt to provide an additional yield stream of, call it 4 to 6% per annum, targeting a market beta to the S&P of about 0.3 over a full market cycle. There's a strategy associated with this. I'll say high level. The other way we see people approach this type of activity is, again, cash on the sidelines, where you have a client say, I really don't want to buy what were or what are near, all-time highs in equities. We can ladder out a series of put options to help you get paid to wait and take delivery of equities down 5%, down 10%, down some percentage at a future point in time. So if you don't have any questions on that one, Lyle, I'll leave it there and open up for questions, and happy to dive in with whatever anyone's got.
Yeah, if you just want to, while we're taking questions, go to that the fifth slide, which I think is a really good illustration for everyone with the different scenarios, so that everyone has an idea in the back of their mind all the different strategies we've talked about. There you go.
So we have 6 questions so far. I'll just kind of list them off. So first question is, how much does the strategy cost to put into place?
So I'll answer that one. Because of a relationship at Telemus that we have with SpiderRock is an outside advisor that we bring in. They obviously are available to talk to the clients, but just like there are situations where we'll bring in a stock or an equity manager or a bond manager or a mutual fund or an ETF, SpiderRock is an outside advisor, and so we've negotiated rates for our clients. So their fee is very reasonable and can typically be absorbed by the income. So the fee is somewhere between 0.3% per year and 0.5% per year. So it's really a reasonable fee given the complexity and the amount of work that it takes to manage this strategy.
Okay, next question is, if my stock is not held at Telemus, can I utilize this strategy?
I'll answer that one too, and Blake, you can jump in if you want.
Yeah.
Go ahead.
No, go ahead, Lyle.
All right. So there are situations where we have clients that have accumulated stock either via IPO or another way, and they have the shares and they have to be held at another custodian. Ultimately, we need to have a relationship at Telemus with assets that can act as collateral to implement these strategies. But if you had 1 million shares of Microsoft that was sitting at, let's just say, computer shares, but you also had your investment portfolio here at Telemus, we have the ability to hedge that Microsoft without the shares actually being here.
Okay, next question is, I've purchased structured notes in the past and have been unhappy with most results. How does this strategy differ?
Blake, why don't you take that?
Yep. So I'll caveat that with, purchasing a structured note is an allocation day one, right? You go out and buy that. By and large, what we've talked about here today is taking an existing equity portfolio and tailoring its payout profile in such a way that it could match a structured note like payout profile that you've seen in the past. I will caveat that with, we do offer a strategy called structured note replication, so that if it is, I'm looking at deploying cash into a structured note, we can certainly help. by and large, most of those structures can be replicated with listed options. But if you've got an existing portfolio that you're looking to alter the payout profile to more closely match that of what potentially could be a structured note, that's what these strategies are helping achieve.
And I'll add, the idea of a structured note is not necessarily a bad thing, because they are hedging risk. Where we have seen issues with structured notes, and we continue to find them, is that there are so many layers of fees in a structured note. Remember, I said 0.3% to 0.5. You look at those structured notes, typically it's well above 2.5% to 3%, because there's commissions, the underwriting fees. That's really what hurts a lot. Plus, and Blake, you can respond to this. Once you purchase one of those structured notes that comes out of one of the wirehouses, there's literally no liquidity. Or if you're forced to sell, you're taking a tremendous haircut on that position. And so that's why we don't believe in the structured notes that are retail products off the street. A structured note that a spider rock creates or replicates or structures gives you some more flexibility. And the final thing I'll say is structured notes are nothing more than an obligation by the firm that's issuing them. And so what we saw in 2008 when some of the financial institutions had issues is that those notes were really unsecured debt of the financial institution, and we do not want to get into a counterparty risk if there ever was another financial stress or crisis. Anything else to add on that, Blake?
No, you hit every point I'd had. The idea of daily liquidity and transparency and no credit risk are the defining features there. So that's one that, again, I will say, I'm sounding like a broken record here. If you guys have got a note you're looking at, shoot it over. Even if we can't replicate it, we can at least help you tell, is this being priced fairly or not?
All right, another one is, if I'm an insider of a public company, can you create a strategy around that if I'm forced to hold some of the stock?
Certainly. So that is a type of work that we do quite a bit actually in the single name hedging category. I will say that every company is different in terms of whether or not they allow for direct hedging or hedging with alternate securities and that kind of thing. We're always happy to dig in case by case, but by and large, I think the solution for that has been our ability to find what I'll call a basis hedge. So find a highly correlated security, i.e. an executive at Exxon who is unable to hedge with Exxon shares directly, but we can create a structure using XLE, the energy spider ETF, to hedge that. So we certainly do have experience with that, and happy to work with you guys on a case-by-case basis there.
Great. So one more. In the first example of a covered call, just confirming that the capital gain risk does not go away if the stock rallies above the strike price.
So that the idea of a no call away provision is obviously important to nearly all of our clients. So this is one of the benefits of having us managing a strategy like this as opposed to yourselves is we've got technology monitoring for what could be considered higher probabilities of an option being assigned. Just because an option moves through strike doesn't mean it's going to be assigned. And so we are proactively managing inventory as to ensure that there are no option assignments which could cause a potential tax liability. So that is certainly a feature that a number of our clients appreciate, and that they don't have to worry about that piece.
And I'll add to that the advantage to having a spider rock involved in this situation is that, and we have experience with clients who do not want to sell their stock in a covered call situation because of the capital gain exposure. They are able to buy back that in the money option that could get called away, maybe go out a few more months. Even though you take a loss, you could sell some stock to match what that loss was in the option strategy. So SpiderRock's done a great job managing that for other clients of ours who do not want to sell the stock. They might not, they might have some losses in the option strategy, but rather than get called away and have the stock sold out from under them, they've done a great job of managing that.
So with that, I just want to thank Lyle and Blake for the webinar. We've recorded this, so it will be on our website very shortly. And if you have any questions, please follow up with your Telemus advisor. Thank you and have a good rest of your day.